think there are three particular signs that suggest equity markets could make further gains, though we wouldn't necessarily want to be overconfident. The first one is that transport indices are still going in the right direction, which is a fantastic sign owing to Richard Russell's Dow theory. Transports are doing well, industrials are doing well, economy is doing well, so that's a big tick. The second big tick is that we're not seeing huge amounts of new flotation activity. I know we need to be careful. AJ Bell's thinking of joining the stock market at some stage in the next 12, 24 months. You can see at real market peaks, lots of offerings coming, some good, most of them not quite so good, and that can suck money away from the markets if those companies then don't pan out. We're not seeing that. That's another tick. The third big tick is earnings estimates are still going up, particularly in the US, helped by the Trump tax cuts. But the fact we've got positive earnings momentum is a much better sign than we've had recently. And if you're looking for things that can go wrong for markets, real accidents happen when interest rates are going up, valuations are stretched, but the real catalyst is earnings estimates going down. We're not seeing that right now. There are three signs that equally mean we need to be more careful. We're already seeing an increase in volatility, so clearly there is a little bit of a shift in market sentiment of which we need to be aware. And I think the first thing we've got to be aware of is merger and acquisition activity. It's off the clock. $1.7 trillion for the first 4 months of this year. That's a record high. It's a sign of risk-taking, exuberance, confidence. And if you look, the 1999 and 2007 peaks also came with a big boom in merger and acquisition activity. So we've definitely got to be careful of that. The second thing that we need to be a little bit careful of is that we are seeing the US yield curve flatten. The premium we get for lending money to the US government for 10 years rather than over 2 years is closing. That can be a recession predictor. It's not infallible, but it is something of which we need to be careful. And the third one is the fact that we're still looking at relatively complacent markets. The VIX index, the fear index, trading below 20 suggests investors are being relatively blasé still. And although you are seeing some cracks, for example, in areas like tech or cryptocurrencies, so it does suggest, again, rather like the M&A, there's an element of complacency out there, and that's normally not always a good thing. We've got to be careful because we all know that the past is no guarantee for the future. Though equally, Sir John Templeton said the four most expensive words in investment are "it's different this time," and he died a billionaire, so I'm going to kind of side with him on this, I think. And he said very clearly, and I think it works for me too, that bull markets are born on pessimism, grow on skepticism, mature on optimism, and die on euphoria. And I think if you look at that right now, you can see certain asset classes in all of those, where you're probably seeing skepticism and pessimism right now, are things like UK equities, the UK pound, value stocks, for example. Where you're probably seeing euphoria at the other end, cryptocurrencies, social media stocks, jam tomorrow stocks, Chinese internet companies. So there's a range. I wouldn't say that all asset classes are all in this one bucket. There's a range of all four. But I think, in terms of where would you like to be looking? Well, applying Sir John's maxim, you need to be looking more towards the pessimism and the skepticism, and perhaps gently moving away from the optimism and the euphoria, because there's value to be had by looking at the things that aren't being talked about right now. And I think areas like the UK, the pound, real estate, for example, value, potentially still interesting areas and potential interesting bolt holes. We have a huge range of potential market outcomes, and central banks don't know what's coming. That's why Bank of England Governor Mark Carney is still doing a hokey-cokey with interest rates, why the Federal Reserve is moving very slowly with interest rates, why the Bank of Japan and European Central Bank aren't really doing anything at all to pull back on their massive amounts of stimulus. We could still have inflation, stagflation, deflation. What we're probably not going to get is what we've just had for the last 10 years of Goldilocks, not too hot, not too cold, low growth, low inflation, low interest rates. Things don't stick around forever, things happen. And so in that respect, advisors, clients, fund managers need to prepare for multiple outcomes, those three outcomes. One thing to consider is Dylan Grice's cockroach portfolio. I know not everybody likes it, but that's why it's interesting in itself. A 4-bucket portfolio, equally weighted, rebalanced once a year, gold, cash, good quality bonds, if they still exist, and equity income. And one of the beauties of that is it forces you to confront your biases. There's always going to be one of those buckets you just don't want to touch, but that's possibly the one that'll save your bacon if your worldview is wrong. And that over time, that portfolio, very crudely built, has only had 3 down years in the last 20 odd, helping people sleep in their beds at night. No bad thing.